Imagine a world where governments print trillions of dollars overnight, markets crash and then soar to record level highs. AI went from sci-fi and afterthought to everyday life, and global unity gave way to nationalism and populism. That's the post-COVID-19 world we live in. Today we unpack how the 2020 shutdown has changed everything and how you can thrive in this new economy. The global economic effects, the shutdown. The pandemic triggered the sharpest economic contrast since World War II. Global GDP shrank by over 3% in 2020 alone. With trade volumes dropping 9.2%, shutdowns halted production, while supply chain interruptions, for example ports, closures of containers, shortages, they created bottleneck effects. Air cargo, which is vital to global economy, 30% of all global trade value, fell by 95%. Passenger flights canceled, delayed, ruined the airline industries. And the supply shock hit emerging economies the hardest. This is the worsening inequality. Global poverty rose for the first time in decades, adding between 100 and 110 million people to extreme poverty. What are the key disruptors, you ask? Well, supply chain. Maritime freights, 90% of trade, delayed due to inspections and driver shortages. Electronics, food, and pharma chains fractured. Economic toll, the worst recession since World War II, with trade predicted to fall between 13 and 32% in 2020. Now in 2026, recovery is uneven. Global GDP has rebounded to pre-pandemic levels. That happened right around 2022. But emerging markets are lagging, with lingering scars like higher debt and inequality. But what was the initial response to governments? What did they do in the beginning of the global pandemic? Well, let's dig a little deep into that. The massive response. Trillions were printed. Where did it go? Who benefited? Why is that important? Well, let's talk about that.
Life is full of choices, but how do all these choices connect? And how do we plan for what matters most? Because when your life goals align with the right financial strategy, you don't just dream, you climb.
Global central banks printed and injected between $9 to $13 trillion. The U.S. Federal Reserve alone printed $3 to $5 trillion in qualitative easing and COVID relief alone. Where are the examples? Where did that money go? I'll give you the examples. PPP loans, $669 billion in forgivable loans to small businesses, kept payrolls intact, but is highly criticized because a lot of this money favored larger firms. Stimulus checks. You guys remember that government stimulus money that we received? In fact, 3 rounds of stimulus. Initially $1,200, followed by $600, and then finally a payment of $1,400 per adult in the United States. That amount totaling $800 billion, which boosted spending and consumer demand, but it also pulled inflation. Another thing that we did during the pandemic is we enhanced unemployment benefits, an additional $600 per week per person, followed by an additional $300. We also extended the coverage of unemployment benefits. The 13 to 24 weeks, a total of $270 billion printed to prevent poverty, but it also did something very interesting. It prevented people from returning to work. Do you remember small businesses having to create bonuses and incentives to get people to come back to work? Why? Well, because people receive more unemployment benefits than actually working. Those trillions printed, again, globally, $13 trillion in COVID, quantitative easing, and infrastructure. The United States alone, $3.3 trillion in 2020 alone. It avoided a deeper recession and caused the stock market to rise in unprecedented levels. From February of 2020 to April of 2020, the market drawdown approximately 32%. But after all these quantitative easing and stimulus monies were printed into the economy, the markets soared and rose 115% from 2020 to now. Well, this has also contributed to inflation. But who are the beneficiaries of all this money stimulated and printed and added to the global economy? Very simple. Those who own assets. What type of assets? Stocks, housing. Those sectors have boomed. Big corporations who borrowed with cheap debt or have had loans forgiven. Governments who have borrowed at low costing. Remember, one of the key responses from the Federal Reserve was to lower interest rates to 0%. So that doesn't just benefit the consumer. That's also governments who borrowed money at close to zero interest rate for them. Inflation surge and central bank. U.S. Consumer Price Index went from 1% to 2% in 2020. But inflation peaked at 9.1% in June of 2022. Why is that important? Because inflation at 9.1% is equivalent to losing 1 month's worth of purchasing power. Given that 70% of Americans live paycheck to paycheck, it's simply not feasible. It's not sustainable for the cost of goods and services to continue to go up. Remember, inflation measures the continuous increase of the cost of goods and services. It's very different from saying where are prices now to versus where they were today. In other words, if you had something that was worth $100 and now with inflation it's selling for $120, what inflation CPI measures is not going from $120 back to $100, but at what rate these levels keep increasing. Well, the rate that inflation was increasing was at 9.1%, simply unsustainable. Now today, things have gotten a whole lot better. As of December of 2025, inflation is closer to 2.7%, with global trends cooling and global inflation around 3.7% in 2026. But we're not close to our target. The U.S. mandate for the central bank is to have inflation at 2%. Now let's go back to what central banks did at the beginning of the inflation. They slashed interest rates to near zero. Why? Well, because if everyone's at home and no one is spending, one of the ways to incentivize people or stimulate people to go out and spend is by making it affordable for people to borrow money. If you remember, there was a brief period right in the beginning of the pandemic where people were able to finance mortgages at 2.5%, 3%, historical rates. And because of why? Because no one's buying a house, right? Who wanted to sell a house in the middle of a COVID pandemic? Nobody did. Who wanted the uncertainty of having a mortgage payment when you didn't know if you were going to have a job tomorrow? Nobody did. But by making interest rates lower, you can buy that cheaper house. You can finance an auto loan payment at a cheaper rate. In fact, maybe a lot of you guys remember this. If you had the opportunity to drive on the freeway and you saw a dealership billboard during the pandemic, you would see 0% financing, no payments for 6 months, up to 1 year even. Why was that? Well, because they want you to buy. And one of the ways to incentivize you during a global pandemic and so much uncertainty is to make it affordable for you to finance. Same thing with other types of loans. But here's what happened. Going back to that inflationary number of 9.1%, we had this interruption that we discussed. All this money printed, circling the global economies. People have money in their pockets because they're not spending as much because they're at home. They don't have access to go out, travel, go to restaurants. But they have the $1,000, the $600, the $1,200. If they have small businesses, they have these PPP loans. So there's demand to spend and spend, but there's no supply because all these supply interruptions that we discussed earlier. So what happens? We have a disequilibrium. We have disbalance. We have too much money and not enough supply. That's what caused, in part, that 9.1 inflationary rate. What is the government's response? They have no choice but to pivot from their position. If you guys remember, the Fed said this inflation is transitory. As soon as things open up and things normalize, this inflation is just going to disappear on its own. And nothing was further from the truth. In fact, the Fed went from from offering rates at 0% to as high as 5.25, 5.5%. Now, what do rates look like today? Well, rates are easing. Why? Because economies are slowing down. The Fed fund rates, it's hovering around 3.5, 3.75% range. We've had up to 3 to 5 rate cuts since the rate reduction began. And right now, a lot of people ask, well, where are rates heading? Well, we know rates are likely to continue going down because if rates stay high and the economy is not expanding or growing at the rate that we want, then we can have a potential deceleration of the economy. We can have a recession. So that's the name of the game for the Fed is how do we find the right balance between controlling inflation? Remember, inflation is still not at 2%. The target rate is closer to 2.7. But at the same time, not creating too much of a slowdown, not creating a global recession. And there's a lot of different factors that come into play here. For example, geopolitical events, what's happening between Russia and Ukraine, that interrupts supply chain. What's happening with the United States and Venezuela, for example, or Greenland, or Israel and Iran. All these geopolitical risks can interrupt supply chains, can interrupt global consumption, can interrupt global GDPs. So the governments are always looking for different economic data that gives us indicators of whether we need to accelerate spending, decelerate spending, and navigate interest rates accordingly. But then now the question becomes, well, who won and who lost by all these changes with printing money, with inflation, with quantitative easing? Who's the winners? I'll tell you who the winners are. In the beginning, debtors and investors. Why? Again, borrow money at a cheaper rate. It's easier to spend that money invested. And if you're borrowing at 2%, but you're able to have a rate of return of 9%, your net profit is the difference, right? That's 7%. Investors who own real assets, savers, wage earners got extremely hurt by this, right? Why? 25% increase in cost of goods and services since 2020. Real wages have lagged. In other words, as the cost of goods and services has gone up 24%, wages have not kept up with inflation. So that means that you feel left behind, right? And that's why you have a lot of people that feel disenfranchised. Well, I'm making the same money, but things are 24% more expensive. I'm being left behind. I'm struggling, which is why we need to own assets that benefit when there's inflation. The financial markets. Markets crash to record highs, plus the AI boom. Initial plunge. The S&P 500 initially plunged over 33% from February to March of 2020. And then we've had an epic rebound. Since then, since the lows of nearly 7,000 points, we now have massive gains to 2025, where the market's average return is about 115%. The pandemic accelerated all of this. Not only that, it changed everything, specifically the explosion in AI. Think about things like Zoom, chatbots, vaccine models, OpenAI. Today, AI technologies and sectors are what's dominate markets. It's changed everything, how we do research, how we communicate, and jobs will forever be transformed. In fact, the question is, how far will AI go? How many potential jobs and sectors will it replace? A lot of that's still to be determined, but there's no mistake. Just like in September 11, we exited into a new world. The AI boom has created a new reality for all of us. Section 5, the biggest shift, populism, nationalism, and deglobalization. Inequality has widened. The disruption in the affordability of goods and services has really caused a lot of people to question the elites and the global systems. Borders have closed. Supply chains interrupted, where we want to now onshore and build domestically manufactured products. The rise of nationalism agenda versus a unified global messages. Geopolitical conflicts. Think about the conflicts are going on militarily wise around the world. And not just that, tariffs. Those are all adding fuel to the fire. And I think that's really where the biggest concern is here amongst everything that we discussed. Because living in a globalized world has its benefits. If your country is good at making coffee and another country is good at making cars, for example, well, there's an exchange, right? You maximize your trade with each other because I buy your product at a cheaper price, better terms because you're good at producing that. Where I might be good at something else, and we have an exchange. Well, now with this increase in nationalism, we want our country first. We want everything built in this country. But the reality is there's a lot of product that is no longer beneficial to be produced in our country. And not just our country. Many countries go through this challenge. In fact, the whole world does. And we all benefit from a more united and collective front. But globalism causes us to say, what is the root of the problem? And we don't want to ever accept that we're part of the problem. We don't want to accept self-responsibility. It's easier to blame the foreigner, the other country, than to say, what is it that we need to do different as a country to rebound from this global crisis? What were the government responses to initial global shutdown? Sweden, for example, had minimal lockdowns. They focused on vulnerability, those who were more likely to get sick from the global pandemic. The effects in Sweden, their GDP fell by 2.8% in 2020 versus the global average of 3%. And they also had low excessive deaths. Now, there's arguments that are made that because, well, in Sweden, they're more spread apart, not as condensed populations, they were able to implement these measures. South Korea, for example, and Taiwan, they focus on early testing, tracking. Their GDP contracted by 1%. And by 2020, they had a quick recovery. Here in the United States, we focus on stimulus, preventing a deeper recession, but unevenly benefiting the wealthy. Key failures. The US and UK, our initial responses. We downplayed the risk of the pandemic. We delayed the lockdowns. And that led to higher deaths, and a 14.7% unemployment in 2020. China, for example, very different. They had strict lockdowns. Some argue that they worked in the short term, but growth and long-term GDP was affected by 2.6% up until 2022. India and Brazil, uneven aid, poverty surge. Informal sectors were devastated. Another key thing that came with the global pandemic was the push on the AI boom. COVID accelerated AI, remote work, research, spiked demand for AI in communications, things like Zoom, research and development in vaccines, modeling, healthcare, diagnostics, changes, faster research, AI drug recoveries, communications, chatbots, sectors blooming like technology. In fact, the tech sector is up over 133% in that time frame. Same thing with finances and AI trading, markets, AI firms. For example, NVIDIA. NVIDIA has seen a historical rally run unprecedented in stock market history. Surges in AI global markets. AI, for example, went from a $104 billion industry in 2021 to its projection of $1 trillion by 2030. The bigger shift, populism, nationalism, and deglobalization. Now, what is populism? What is nationalism? It's messaging that appeals to the masses, things that people want to hear, right? A token cop-out of why we're experiencing the things that we're experiencing. Nationalism, a sense of taking pride or focusing in our country first, which is a global presence, a global responsibility. Think about, for example, the United States want to take over the Panama Canal, or outright saying we're going to overthrow Maduro in Venezuela, and we're doing it for our national interest in oil. That's not something that, a messaging the United States had before. It was always about spreading freedom or stopping communism or threats in global terrorism. But this time around, no, we're focusing on nationalistic interests first, America first. That's a rise, and not just here. You see that happen in Russia. You see that happen with Israel. You see that happen in Iran, and the list goes on. And countries are saying, we're going to focus on our national interests first. We're going to sidetrack from global interests, and that can be a scary and dangerous thing, because you have a global community that's not as unified, working collectively to addressing global issues. And it opens the door for conflict. It opens the door to rationalizing things or actions that might have not been perceived as the best interest for any nation, its peoples, and obviously the world. But how did we get here? Well, you have an inequality widening, right? The distrust of elites and global systems. Borders closed, supply chains interrupted, onshoring, the rise of nationalism agenda versus unified globalism, geopolitical risk, conflicts, and tariffs. Those all add fuels. And I've always found it interesting that in humanity, we don't take a step back and really analyze all these divisions and all these lines and borders. They're not God-made. They're man-made. We find a way to label someone who's different than us as other, as a threat, when in reality, if you really take a step back and assess, we have a very brief time in Earth. We have a shared brief common moment that we all live in this planet together. For some reason, we haven't really realized that Well, we benefit when we work together. We benefit when we collaborate as a species, as a race, as a human race, and really look out for each other's interests, because people have different ideas. They bring creativity, new products, new medicine, new technologies. By empowering each other, we basically create a better world. But when we see each other as a threat, as enemies, as an opposition, then that tends to lead to war, conflict, suffering, human suffering. And this is a mistake that's made over and over and over throughout human history. And I hope that we can see the warning signs coming, and realize that in all religions, for example, we're called to help each other and collaborate and work together, and to love our neighbors and the poor, and take care of each other, and not so much this nationalist ideology that's floating around today. Again, in a globalized economy, your country's efficient at creating certain products and services. Mine is efficient at doing other products and services. We have an exchange, and we both benefit from that. And that's really been the American message for a long time, until recently. And my consideration would be that that's because a lot of people feel left behind with the pandemic, right? A lot of people feel like they were cheated, like all these trillions of dollars that we discussed, remember, over $13 trillion globally. In fact, the United States, between Trump's and Biden's administration, because quite frankly, they've both done the same. They both print money. They both create stimulus. We're talking of over $9.1 trillion that helped prevent a global catastrophe, maybe a recession like the world had never seen. But it also created unprecedented inequality, right? Those that understand these cycles, and this is why it's so important for us to have these conversations. Well, they bought assets, they bought real estate, they bought stocks, they opened businesses, and remember, buying an asset is not a guarantee that you're going to see return immediately. It really requires patience and discipline and time to really see the results. But and I'll give you an example. If you invest in the market prior to the global shutdown, let's say February of 2020, and we know that the market drawdown was at March 15 of 2020. You're talking about 32% drawdown in a month and a half, followed by some recovery. In fact, by August of 2020, the market had recovered 100%. You had some continued growth into 2021. But by 2022, when the Federal Reserve started raising interest rates, well, the market had to respond, right? It says the Federal Reserve is raising interest rates to slow consumption. So that means an economic slowdown and potentially a recession. So that's why we had, from December of 2021 to October of 2022, where we're talking about a little bit over 10 months, a drawdown of about 22%. If you don't have patience and discipline in those cycles, and granted, it's normal for human nature to say, well, I'm going to capitulate, I'm going to sell my assets because 10 months, 11 months of this not working, you really miss out on the efficiencies, right? What ended up happening is we didn't have a recession. The economy stayed resilient. People kept spending and consuming. And now if you measure the average return from pre-pandemic levels to now, you're talking about the average rate of return is about 115%. And granted, that's the average. You have some sectors and industries that have grown 150%, 200%, 300%. You have stocks like NVIDIA that have grown in the thousands of percentile. So the understanding of cycles and discipline, and also having a game plan, right? And that's what we're going to be talking about in our next episode of The Climb. But for now, let's talk about key realities, right? The reality is that our nation is at $38 trillion in debt, and it's persistent. Yes, we have a cooling of inflation. Yes, we have an AI-driven growth. We have volatility and geopolitical risk. But for context on fiscal borrowing, for example, over the term, Trump added $4.8 trillion in non-COVID relief and $3.6 trillion in COVID relief. while the Biden administration added another $2.2 trillion in non-COVID relief and $2.1 trillion in COVID relief. So think about how much money we've added, right? That tells you how both parties are surging our national debt. Okay. But again, understanding how to navigate and benefit from an influx of money that literally comes from nothing is the key to navigating any economic cycle. So what's my advice? Understanding economic cycles. What drives increase in consumption, in spending, obviously, in what are the factors? Well, we know printing money, lowering interest rates. What causes reduction in spending and consumption and reduction in GDP? The opposite. Removing money from the system, increasing interest rates. And during every cycle, there's always industries and businesses that benefit. Understanding what those are is the key to navigating the cycle. And also understanding when is it appropriate to be patient and tolerant? When is the drawdown that I'm experiencing a result of geopolitical risk, of idiosyncratic risk, of risk that are beyond the effects of my specific investment, my company, my industry? It could be that all the companies in my industry are down because of something that the global economy is experiencing. Or is this really a drawdown because I invested in a company that's not operating efficiently because they don't have the right administration, the right reserves, the right marketing, the right sales? Those are the questions and answers that we need to ask ourselves and really understand. And the other thing is making sure we have reserves, a bundle of cash reserves for in an emergency fund, a rainy day. You lose your job, you get sick, unexpected repairs, the economy slows down. Ideally, you want to have at least 6 to 12 months in reserves to help you ride that short wave until things get better. And then obviously diversification, right? Obviously, we all understand that AI boom, the technology boom has been great to us, but it also exposes us to any major correction, right? So what I mean by that, if your entire portfolio or investment portfolio is weighted on technology and technology has a slowdown or drawdown, well, guess what? You're overexposed. You're going to have a higher drawdown than someone that's more diversified. So when you're over concentrating exposed, being conscious of the fact, if you're doing that because you choose to live with a concentration risk, then at least understand that. But if you want to minimize the potential drawdown, then what you do is you diversify a little bit better across different sectors and industries. The other thing is balance, right? Finding the right balance between bonds and stocks. And we'll get into another episode of The Climb explaining how the relationships work between bonds and stocks. Remember, bonds are lending money to entities, governments, corporations. Stocks are ownership of publicly traded companies, right? And then the other is using the technology that we have today with this new world, with this AI boom. Understanding, how technology can be our friend, how can make things easier, more efficient for you, how can you use it to support your businesses, your research. And lastly, managing debt wisely, understanding how to hedge against inflation, not having funds just sitting in cash, and being ready for the curveballs that will inevitably come at all of us. COVID-19 broke the old world, but remember, it also built a new one full of opportunity, one full of innovation, new technologies. Position yourself smartly, and you'll find yourself climbing faster, higher than ever before.
Life is full of choices, but how do all these choices connect? And how do we plan for what matters most? Because when your life goals align with the right financial strategy, you don't just dream, you climb.